Welcome back. This is Professor Marsh, and this is going to be a short but important second lecture on Unit 6, and we're going to review Chapter 4, and in particular Section 4.5 in your materials. Now, before we get to that, I do want to mention a few things in review of Chapter 3. Chapter 3 was the chapter about analyzing and recording transactions, and of course that's a very, very important chapter, and it's one that is worth reviewing for a number of reasons. One is that it really gets us into the whole basics of the accounting equation and preserving the accounting equation of assets equals liabilities plus equity. And it also begins to show us the expanded accounting equation in which the components of equity are broken into additional subcategories here, which you can see this is actually out of Chapter 3. And I wanted to show you something, and I don't know if you can read it up close, but this is the basic accounting equation, and then this is the expanded accounting equation, which they spend a lot of time talking about. But I want to talk about manipulation of the accounting equation and maybe go through a little bit of math that we may have forgotten since middle school. Remember, assets equal liabilities plus equity, and so I've written that across right here. What if you want to know what equity is? How do you get to equity from assets equals liabilities plus equity? How do you solve for equity? Well, what you do is you subtract liabilities from both sides. And so that's what we're going to do. And so if we subtract liabilities on both sides, okay, so what we've done is we have in a little equation right here, we're going to add these two equations together. So assets equal liabilities plus equity. Then we're going to subtract from both sides liabilities. Minus liabilities on this side equals minus liabilities on that side. What do we end up with? We end up with assets minus liabilities equals equity. See how that works out? That the liabilities on this side cancel out, and we're just left with asset minus liabilities equals equity. Well, you can manipulate all of the homework problems in a similar way. When you have those homework problems with the question mark in the equation, you can manipulate the equations, and it will save you a lot of time if you're having trouble conceptualizing it, just to use subtract the numbers equally from both sides until you get the question mark on one side of the equals sign. And so that's just one way to do that. And of course you can add the equal amount to both sides as well and get those to cancel out. But for those of you who are having problems with that, just understand that's a short way to be safer in manipulating those equations when you're doing the homework problems. Another thing I want to mention in Chapter 3, we went into it during the lecture, but as you see down here at the bottom of this page in Chapter 3, you can see the beginnings of an understanding of the chart of accounts. And the chart of accounts is extremely important as we go further in accounting. We're just learning the basics of it right now, but the numbering system in which asset accounts always start with 1, and liabilities accounts always start with 2, and equity accounts always start with 3, and revenues are always 4, and expenses are always 5. That system is something that is very important, and if you use QuickBooks or Peachtree or Sage or one of the other systems, or even an Excel spreadsheet that somebody's put together for you, you just might not see that and think about it, but it's very important in setting up good accounting practices to have that particular system in place with a chart of accounts. It's what a lot of accountants and bookkeepers are paid to do. It's a good engagement for setting up a new business, is to set up their chart of accounts. And some people who set up charts of accounts will, use 100 for the cash account, and then 110 for accounts receivable, and 120 for inventory and things of that nature. Sometimes they'll have multiple cash accounts, and maybe they'll start 101 for cash, and then if it's the cash that's at Bank of America, it'll be 101.1. If it's the cash that's at Wells Fargo, it'll be 101.2. If it's the cash that's in the drawer as petty cash, it might be 101.9, leaving room for additional banking relationships for those larger businesses that have multiple banking relationships. So in any event, just a beginning exposure to some of those concepts that you will revisit as you go further and further in your accounting study. Now I want to move to Chapter 4 and Section 4.5. And you remember the learning objectives of Section 4.5 were to prepare the financial statements using the adjusted trial balance, and we had a review of what the income statement was, that it shows the net income or loss as a result of revenue expense activities during a period, the statement of retained earnings. It shows the effect of net income and dividends on the earnings that the company maintains. The balance sheet visually represents the accounting equation showing that assets balance with liabilities and equity. And then also there was a discussion of the 10-column worksheet. And I'm going to skip the 10-column worksheet right now. I have to say, in reviewing it, and I know I mentioned it earlier, I told you that I was going to spend more time on it. I think just seeing it is enough. I see the 10-column worksheet as something that's just busy work. If you have good understanding of the other financial statements, the journal entries, the ledgers, the T accounts, those sorts of things. So I'm going to skip that for right now, and maybe we'll come back to it later in the semester. But I just think that it's too much busy work just to copy everything down across those 5 sets of dual columns with debits and credits, and I'm not sure that it adds that much to your learning. But this is very important stuff. So in Chapter 4.5, remember we were introduced to the concept of adjusting entries. And why do we need adjusting entries? Well, in Chapter 3, we have all the entries, all the journal entries that we make in setting up the T accounts for transactions that are going to be in our general journal. When we buy things, we're going to pay cash or incur credit in order to buy things. When we sell things, we're going to get cash or we're going to get credit. And so we're going to have all those transactions are already going to be recorded in the general ledger, and will find their way onto the trial balance. But as we get to the end of a period, there are some accounts which we have to actually look at in more detail and look at if there's appropriate accruals that need to be made to either offset earlier accruals that we made or just to recognize that we used some of the assets or that we incurred liabilities at the end of the period, even though we haven't paid or accrued anything yet in the general journal. And so there are examples of lots of those. And when you look at the beginning of the chapter, they have that example of magnificent landscaping service, which you're supposed to go ahead and do this through. And you can see that I've circled in red a number of the accounts that are on the adjusted trial balance. And why did I circle them? Well, I circle them and put arrows next to them because they represent those kind of special accounts that typically need to be adjusted. And so you'll see an entry on there for office supplies. And office supplies is the sort of thing that often has to be adjusted because you use them during the period, but nobody makes a journal entry for it. You know, people just go to the office supply cabinet and they take some paper out, or they take some pencils out, or erasers, or whatever they use, and they just use them. And then you've got prepaid insurance. Typically insurance or rent, for example, are paid in advance, and then during the period you may use some or all of those prepaid insurance, and so you have to offset that asset account by recognizing the expense that you have for the use of those prepaids during the period, so that you're properly matching expenses with the period in which you incur them. Similarly, you've got equipment. See, equipment's on there at $2,500, but you've got accumulated depreciation for equipment of $35. And why? Because you had to depreciate the equipment, and this little period, this one short period, you used up $35 worth of the $2,500 of equipment that you had on your balance sheet. So that's also an accrual that needs to be made as one of your adjusting entries. Then you can see on here you've also got an adjustment for salaries payable. See salaries payable on there. Apparently when we got to April 30th, we were in between payroll periods, and so we had accrued $420 that we owed to our employees as of April 30th, but we aren't going to pay them until May, and so that's on the books as well. And then apparently somebody paid us for some lawn mowing revenue, and we hadn't done the job yet, and so that's another accrual that's on there as well. Or perhaps during the period we had to accrue some of the lawn mowing revenue because we did some of the jobs that we were paid for in advance. And you can see those examples show up in this first example of the landscaping service. And then what the book does is it takes you through the example of Printing Plus, and it takes you through their income statement. As you can see on the income statement, you're presented with that income statement, and then you also see the adjusted trial balance. And sadly, my printing cut it off at the top of the page, but you can see the income statement there. And then over here, there is this adjusted trial balance, and it shows you where the income statement accounts come from on the adjusted trial balance, and how they're reflected on the income statement that's prepared off the adjusted trial balance. And so you can see that example right here, and you see the interest revenue is one of your that's the first blue line that takes you from the adjusted trial balance over to the income statement. And then service revenue, 10,100. Then you've got supply expense, and remember the supply expense is something that's going to be one of your accruals. And you've got a depreciation expense on equipment, and salary expense, and those numbers, utility expense, those all come over and form your income statement. Now remember, when you were looking at the discussion of how to make these adjusting entries, let's just look at a few of the adjusting entries. And I've shown the adjusting entries, or where they show up on the trial balance. Let's look at the depreciation first. So what we did is we set up over here this credit entry. This is what's called a contra asset account. Remember that for depreciable assets, when you book a depreciation entry for them, you don't put it on the liability side. The credit entry, instead of going on the liability side of the balance sheet, goes as a contra asset. And so you've got the original cost of the equipment of $3,500, and then a little bit of depreciation in the contra asset account for accumulated depreciation. And then the offset to that is down here, and it's kind of hard to read the way they have it presented, because the description is so long that it takes up 2 lines in that description column. But it's depreciation expense : equipment here in this red circle, okay, and that's the $75 debit that's the expense that you book to offset the depreciation in your equipment. So you credit the asset to reduce it, and then you book the expense for depreciation. Now here's another one up here for supplies. Okay, so this is the supply cabinet. You had $500 in supplies at the beginning of the period, but you used $100 worth down here, and that's the entry that's circled, the two entries that are circled in blue. And so the adjusting entry was to reduce the supplies account from 500 down to 400. That was a credit entry. You don't see it on the adjusted trial balance because it was just a subtraction from the $500 in supplies down to 400. But you see it down here on the income statement account where you've got supplies expense of $100. That's going to go onto your income statement. Then another adjusting entry is the one for salaries. So we talked about, how the period in this case ended on January 31st, and you had you've got salaries payable of $1,500, which you've booked because those are people who did work for you in January, but they're not going to get paid until February or sometime later. And so you've incurred the expense, and down here it adds to the salaries expense that you had. This includes both the cash that you paid as salaries plus the $1,500 extra that you had accrued by January 31st, but maybe your payroll period ended February 5th, and so you're not going to pay it until after the end of the period. So anyhow, to correctly reflect income for the month of January, you have to accrue all the revenue that's associated with it and all the expenses that are associated with that period. And that's what adjusting entries do, or some of the adjusting entries do. Okay. Then you have your statement of retained earnings, and there's an adjusting entry for retained earnings, or you've got the statement of retained earnings takes entries from both the net income that's on your income statement, and you saw that up above. That's where is it? Right here on this. Okay, here's the statement of retained earnings. So here's the net income that comes over to the statement of retained earnings, and then you also have dividends, and that comes from your adjusted trial balance, and so that affects the ending retained earnings. So you had earnings of $46.65, and then you have to subtract the dividends that were paid out of $100, and so the ending retained earnings are $45.65. And in this case, we're assuming it's a brand new company, and so the beginning retained earnings, instead of just really being a blank there's really a zero right up above net income. Okay, beginning retained earnings was in fact zero right there, and that's how that works. So that's the statement of retained earnings. Now that we have the statement of retained earnings, we can prepare the balance sheet. And so we now have the balance sheet, and of course we have a page break here too as well, but you can see it together with the various accounts, and you can see that total assets equal total liabilities plus stockholders' equity after you've made the adjustments on both the income statement and the statement of retained earnings. So that is the presentation and the preparation of the financial statements from the adjusted trial balance. And of course your book, since it likes to teach it to you two different ways, has another page that shows you where the adjusted trial balance and all the other items go on the proof of how they're all reconciled. So that's the preparation of financial statements with the adjusted trial balance. And with that, we're going to say goodbye to section 4.5 in your book, and we're now going to go on to chapter 5 and take a brief look at section 5.3 again, the important issue of working capital and the classified balance sheet, and then on to the preparation of the financial statements after the closing entries have been made for the period, so that we can start fresh in the next period with a nice clean set of accounts. So good luck as you study for your midterm, and with that I'll say goodbye, and we'll see you again next time. Thanks a lot. Bye-bye.